All right, boys and girls. So we are now back, and in this section, I'll be talking about liquidity and how it is important to understand the concept of liquidity and identify liquidity on the chart. So liquidity, again, is just like trend lines, just like any other concept. It can be found on any time frame that we want and look at. Liquidity is essentially a concept in a way for banks and big institutions to stop out traders, let hit traders that are in their position hit every trader's stop loss and then reverse price going in their favor. And the way they do this is they use things called liquidity sweeps. So first off, we do want to identify what liquidity is, right? Liquidity is basically where places where you can find like major wicks. That's the easiest way to define liquidity. Major high areas, right? So areas like this, there'll be a lot of liquidity because there's going to be a lot of price action and price movement that recurs in this area because it's a very key area. So liquidity is found in key areas of support and resistance that institutions utilize to gain an advantage on their position and allow all their orders to be filled essentially in an effective manner. So let's find ways we can circle and find liquidity on the chart. Liquidity usually comes in the form of key areas, key levels where there's very big moves that occur, and when there's big moves, you will see big wicks as well. So right here, boom, liquidity right here, boom, liquidity right here. This is a very prominent liquidity right here. We have some liquidity over here as well. And liquidity is basically what institutions utilize to stop out a lot of retail traders before they make a huge move. So you want to look for these big moves in the start of these big moves. And near the start of these big moves is where you'll find tons of liquidity because these are key areas everyone is protecting, defending, or attacking. So we can see tons of liquidity. These are all areas of liquidity. Areas with big wicks, big reactions near key levels, or areas followed by a strong big move. That's the best way I can define liquidity. Institutions love targeting liquidity areas because they want to get their big orders filled, right? For every buyer, there must be a seller. So for institutions to fill $10 million in orders, they need to have a lot on the other side. They need 10 million buyers or sellers willing to sell or buy their position and give it and hand it over to the institution so they can fill their orders. It's not easy to be getting your orders filled with millions and millions of dollars in a day trade like institutions. That's why they need liquidity. All right, so now that we know these are areas of liquidity, well, how can we utilize liquidity in trading? Well, there's a thing called liquidity sweeps. Now, I would say this is an important concept to understand, but you shouldn't really play off of it all the time because liquidity sweeps do not occur every single time, okay? This is right here is a perfect example of liquidity sweep though. Right here, basically liquidity sweep is where we take out previous level of liquidity and then we bring price in the reverse direction. So right here, if we can identify with the ray, Alt J on your keyboard, we can have this ray right here. And this is our area of liquidity. We would define this as liquidity right here. What institutions would do is they bring price and shoot it up to sweep liquidity. What does that mean? We're sweeping liquidity like, NBA teams sweep each other in the finals. We're sweeping liquidity, meaning we're breaking past this level and stopping out everyone. Because when people see a candle like this, they're going to be, look, they're even supply and demand traders. They're going to be entering off when price touches this area, right? Where is their stop loss going to be? Right above this area of liquidity. Okay, so for people that don't understand liquidity concepts, they will get stopped out off this move right here before price goes back in their direction by a lot. So once you get stopped out, a lot of traders get stopped out both going up and down. That's when institutions can fill their orders and take advantage. So this is considered a liquidity sweep. When we break past previous liquidity, stopping out everyone, and then allowing institutions to fill their orders. So the problem with liquidity sweeps is we don't know how much and how far the liquidity sweeps are going to be. Sometimes they only sweep liquidity up a little bit. Sometimes they sweep liquidity up a lot. And this all varies based on internal market order, internal order flow, right? Which is something that they secretly most likely have access to that we don't have, which is the internal liquidity order flow. So every situation is going to be different. This is why I say trading is not binary. It's not ones and zeros in black and white. All based on where liquidity and everything resides in markets, orders. So they stop out everyone and look what happens. They push right into the direction of your bias, which is pushing down. So that is considered right there something you want to just take into consideration when you're trading is be aware of liquidity sweeps. And this is why having extra set of confirmation actually in your trades is a better way of trading than just trading when it touches a zone. Because let's say if you trade when it touches a zone, you're getting stopped out here. But guess what? What about the traders that are waiting for extra confirmation? Well, when you're a trader that's waiting for extra confirmation, the odds of you becoming liquidity are extremely low because you're waiting for market structure to shift to your direction before it basically continues the direction. While people that are having these aggressive entries when zones get hit, they're more prone and prominent targets of liquidity because they're expecting price to reverse soon and they don't have any confirmation that price is going to reverse at that point, right? There's no confirmation the supply zone is going to hold before you become liquidity and then come back right down. So people that don't have confirmations, like we mentioned, breaking structure or trendline breaks, they get stopped out here. While people with trendline breaks, this is a really bad trend line. Another thing I want to mention about trend lines is you can't draw trend lines on very steep slopes or very not steep slopes, right? You want to have a good 45-degree angle most of the times for your trend lines. If it's like very steep slope, you can't really draw a trend line off of it. So that's another thing when it comes to drawing trend lines. You want to make sure you're paying attention to slope. But let's just say we have a trend line here, okay? Let's just pretend price wasn't this steep. We had a trend line here. We would actually avoid being liquidated because liquidity comes first, the sweep comes first before the market structure breaks. That's almost always the case. Liquidity sweeps occur. Okay, let me write this down real quick. Liquidity sweeps almost always occur before the break of structure. So this is why a lot of traders love waiting for a break of structure as extra confirmation. So you do not become liquidity and you don't have to worry about having these extremely big stop losses or take these massive losses, right? Because the spread when liquidity happens like this is going to be awful. People that have their stop losses here, you're most likely going to get stopped out up here, which is horrible. Your risk reward is completely off there. So that is liquidity and liquidity sweeps in a nutshell. Basically something you just want to be looking for, and you don't have to worry too much about liquidity sweeps when you're playing a break of structure. But for people that are playing break of structures, I would highly recommend you look into liquidity sweeps and focusing on that. So one way traders do play liquidity is they wait for liquidity sweeps to occur first before they enter their position, which is smart. But another problem with that is there are times where there is no liquidity sweep, right? So there are multiple times where price does not do a liquidity sweep. Like for example, right here, there's no liquidity sweep at all here. We have no extremely big wick or push below these lows, and we continue right up. If you're a trader waiting for a liquidity sweep, you would have missed this major move. Straight up, you would have missed this major move. There's a lot of moves you would actually miss right here as well. There's no liquidity sweep up here. You would have missed all these moves right here. So me personally, I don't wait for a liquidity sweep, okay? Because I know that I'm going to be having a lot less winners if I'm waiting for a liquidity sweep to occur. So one or the two, I'm either entering off the zone strongly aggressively, or I'm best case situation waiting for a confirmation within that zone, break a structure or break a trend line, and then entering. That way I protect myself from these liquidity sweeps. It's very rare to see liquidity sweeps occur after a break of structure, okay? So that is basically the gist of liquidity sweeps, the logic behind them. And one more thing about the logic behind these liquidity sweeps, right? In these key areas, okay, there are two types of traders. There are traders playing breakouts and there's traders playing reversals. There are two types of traders. Continuation traders that trade breakouts expecting price to break out of this area because most times these are retail traders, okay? Or very basic traders that are trying to play price continue up, thinking it's going to continue up. In reality, they're not looking at the higher time frame, realizing this is a supply zone. There are traders right here trying to literally play a breakout up here, which in this situation, yes, you could say they won because this was a big liquidity sweep. But if the liquidity sweep never really reaches that high, usually a liquidity sweep will reach around here, right? It would never hit their price target of these breakout traders. And what happens is once price reverses, it takes out the stop loss of all these breakout traders. So they have the stop losses in orders of all the breakout traders, and they also have the stop loss orders of all the reversal traders on the other side. So this is a lose-lose situation for all retail traders. Literally, they take out your stop loss if you're playing a reversal with stop losses above here. It's a lose-lose situation for both sides. This is why I understand liquidity and understand what it is and how logic works and affects performance and affects the market is extremely important when you're trading. So that is personally how I understand liquidity, how I utilize liquidity in my everyday trading. When I do notice it, if I don't notice liquidity, I will not be I usually don't have to worry about liquidity in the first place just because I enter usually off of entry confirmation. But again, that's going to be it for this video, and I'll see you guys in the next one.